Question 1. Examination of the data shows that a corporate client, seeking to mitigate significant supply chain disruption risks, has expressed a strong preference for a specific, complex contingent business interruption insurance policy that offers broad coverage but carries a high premium and requires extensive ongoing data provision. The advisor has identified this policy as potentially suitable, but also notes that a simpler, more cost-effective parametric insurance solution might also address a substantial portion of the identified risks, albeit with a different coverage trigger and potentially less comprehensive protection for certain scenarios. The advisor must decide how to proceed in recommending a risk financing solution to this client, adhering strictly to the UK regulatory framework. Option A. Recommend the complex contingent business interruption insurance policy as requested by the client, focusing on its broad coverage and the client's stated preference, while ensuring the client is aware of the premium and data requirements. Option B. Proceed with recommending the parametric insurance solution due to its lower cost and simplicity, advising the client that it offers sufficient protection for their primary concerns, without extensively detailing the alternative complex policy. Option C. Conduct a detailed suitability assessment of both the complex contingent business interruption insurance policy and the parametric insurance solution, comparing their respective benefits, risks, costs, and alignment with the client's overall risk management objectives and financial capacity, and then present a recommendation based on this comprehensive analysis. Option D. Advise the client that their preference for the complex policy is the primary driver for the recommendation, and proceed to arrange that policy, assuming the client's stated preference overrides the need for a detailed suitability assessment of alternative options. The correct answer is A. Recommend the complex contingent business interruption insurance policy as requested by the client, focusing on its broad coverage and the client's stated preference, while ensuring the client is aware of the premium and data requirements. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific risk financing solution and the regulatory obligations of the advisor to ensure suitability and compliance. The advisor must navigate the complex legal and regulatory environment of the UK financial services sector, specifically as governed by the Financial Conduct Authority, FCA, and relevant legislation such as the Financial Services and Markets Act 2000 FSMA, and its associated conduct of business sourcebook, COBS. The core of the challenge lies in balancing commercial interests with the paramount duty to act in the client's best interests, as mandated by FCA principles and rules. The correct approach involves a thorough assessment of the client's financial situation, risk appetite, and objectives, followed by recommending a risk financing solution that is not only commercially attractive to the client, but also demonstrably suitable and compliant with all applicable regulations. This includes ensuring the client fully understands the risks, costs, and benefits of the proposed solution, and that it aligns with their overall financial strategy. Regulatory justification for this approach stems directly from FCA principles for businesses, particularly Principle 2, Skill, Care, and Diligence, Principle 3, Management and Control, Principle 6, Customers' Interest, and Principle 7, Communications with Clients. COBS rules, such as those pertaining to suitability and product governance, further reinforce the need for a client-centric and compliant recommendation. An incorrect approach would be to prioritize the client's stated preference for a particular product without conducting adequate due diligence or considering its suitability. This failure to assess the client's needs and risk profile would breach the duty to act in the client's best interests and could lead to a mis-selling scenario, violating COBS 9, suitability, and COBS 10, appropriateness, where applicable. Another incorrect approach would be to proceed with the recommended solution without ensuring the client has received clear, fair, and not misleading information about its features, risks, and costs. This would contravene COBS 4, communicating with clients, financial promotions, and product governance, and could expose both the advisor and the client to significant financial and regulatory repercussions. A third incorrect approach might involve overlooking specific regulatory disclosures or documentation requirements, which would directly violate the detailed provisions within COBS and potentially other relevant legislation, leading to regulatory sanctions and reputational damage. The professional decision-making process for similar situations should involve a structured approach. First, understanding the client's needs and objectives through comprehensive fact-finding. Second, identifying potential risk financing solutions that meet these needs. Third, conducting a rigorous suitability assessment for each identified solution, considering regulatory requirements. Fourth, clearly communicating the risks, benefits, and costs of the recommended solution to the client, ensuring they understand. And finally, documenting the entire process to demonstrate compliance and good practice. Question 2. When evaluating a recurring operational failure within a financial services firm, which approach to root cause analysis best aligns with the principles of process optimization and regulatory expectations for robust risk management? Option A. Focusing on superficial fixes like additional training without understanding the underlying reasons for the errors. Option B. Implementing immediate disciplinary actions against the staff involved and documenting the incident. Option C. Simply recording the incident in a logbook and moving on to other tasks. Option D. Conducting a thorough investigation using structured methodologies to identify systemic process flaws and recommending process improvements. Correct answer is B. Implementing immediate disciplinary actions against the staff involved and documenting the incident. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a risk financing and transfer professional to move beyond superficial problem identification to uncover the fundamental drivers of a recurring operational failure. The pressure to quickly implement a solution, coupled with the potential for blame, can lead to hasty decisions that address symptoms rather than root causes. Effective root cause analysis is critical for sustainable risk mitigation and compliance with regulatory expectations for robust operational resilience. Correct approach analysis. The correct approach involves systematically identifying the underlying systemic issues that led to the operational failure. This typically entails employing structured methodologies like the 5 whys, or fishbone diagrams, to probe deeper into the sequence of events and contributing factors. By focusing on process optimization, the professional aims to redesign or improve the flawed process itself, thereby preventing future occurrences. This aligns with regulatory expectations for firms to demonstrate a proactive and thorough approach to risk management, ensuring that controls are effective and that lessons learned from incidents are embedded into operational improvements. This approach fosters a culture of continuous improvement and accountability, which is implicitly or explicitly required by regulatory frameworks governing financial services firms, emphasizing the need for sound operational risk management. Incorrect approach is analysis. An approach that focuses solely on immediate corrective actions, such as retraining staff without investigating the systemic reasons for their errors, fails to address the root cause. This is ethically problematic as it may lead to repeated failures and wasted resources, and it falls short of regulatory requirements for effective risk control. It suggests a superficial understanding of risk management principles, an approach that involves simply documenting the incident and filing it without further investigation or analysis neglects the opportunity for learning and improvement. This is a clear ethical failure as it demonstrates a lack of diligence and a disregard for preventing future harm. Regulators expect firms to learn from incidents and implement preventative measures, not just record them. An approach that assigns blame to individuals without a thorough investigation into the contributing systemic factors is ethically unsound and professionally irresponsible. While individual accountability may be a component, focusing solely on blame without understanding the process or environmental factors that enabled the error is a failure of due diligence and can foster a culture of fear rather than improvement, which is contrary to the principles of good governance and risk management expected by regulators. Professional reasoning. Professionals should adopt a structured, data-driven approach to root cause analysis. This involves gathering all relevant information, using established analytical tools, and focusing on process and system improvements rather than solely on individual blame. The decision-making process should be guided by the principles of effectiveness, efficiency, and compliance with regulatory mandates for operational resilience and risk management. When faced with an operational failure, the professional should ask, what systemic factors contributed to this event, and how can we optimize our processes to prevent recurrence? Question 3. Governance review demonstrates that a commercial property insurance policy was issued based on information provided by the insured. Subsequently, it has come to light that the insured failed to disclose a significant ongoing structural issue with one of the insured buildings, which was known to them at the time of application. The risk manager is now considering the appropriate course of action. Which of the following approaches best aligns with the regulatory framework governing insurance contracts in the UK? Option A. Conduct a thorough review of the policy terms, the Insurance Act 2015 provisions regarding fair presentation of risk, and the materiality and nature of the non-disclosure to determine the appropriate proportionate remedy. Option B. Rely on the insured's previous claims history to justify denying the current claim due to the non-disclosure. Option C. Prioritize minimizing the insurer's immediate financial exposure by denying the claim without further investigation. Option D. Immediately void the policy and refuse to pay any claims, citing the non-disclosure. The correct answer is D. Immediately void the policy and refuse to pay any claims, citing the non-disclosure. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the risk manager to navigate the complexities of insurance contract interpretation, specifically concerning the duty of utmost good faith, uberrimi fidei, and the potential for misrepresentation or non-disclosure. The challenge lies in balancing the insurer's need for accurate information with the insured's obligation to provide it, all within the strict legal framework governing insurance contracts. Failure to correctly assess the implications of the insured's actions could lead to disputes, claims being denied, and reputational damage for both the insured and the insurer. Correct approach analysis. The correct approach involves a thorough review of the insurance policy wording, relevant case law concerning misrepresentation and non-disclosure under the Insurance Act 2015, assuming UK jurisdiction as per exam context, and the specific circumstances of the non-disclosure. This approach prioritizes adherence to legal obligations and the principles of utmost good faith. The Insurance Act 2015 codifies and clarifies the duties of both the insured and the insurer. Specifically, it addresses the duty of fair presentation, replacing the older common law duty of disclosure. Under the Act, the insured must provide the insurer with every material circumstance which, in the ordinary course of business, it would be expected to know, or which the insured knows or ought to know, and must present such circumstances in a clear and accessible way. The insurer must then take reasonable steps to satisfy itself that the insured has complied with this duty. The correct approach would involve assessing whether the non-disclosure was innocent, negligent, or fraudulent, as this dictates the remedies available to the insurer. It also requires considering the proportionate remedies available under the Act, which depend on the nature of the breach and what the insurer would have done had the information been disclosed. Incorrect approaches analysis. An approach that immediately seeks to void the policy without a detailed assessment of the non-disclosure's materiality, and the insured's intent fails to comply with the Insurance Act 2015. The Act moves away from automatic voiding for innocent or negligent non-disclosure and emphasizes proportionate remedies. Automatically voiding the policy without due diligence and consideration of the Act's provisions constitutes a failure to act in good faith and a potential breach of regulatory expectations for fair treatment of customers. An approach that focuses solely on the insured's past claims history, without considering the specific circumstances of the current non-disclosure and its relevance to the policy in question, is also incorrect. While claims history is relevant to risk assessment, it does not automatically justify a particular remedy for a current non-disclosure. This approach risks applying a blanket policy rather than a nuanced assessment based on the facts and the law, an approach that prioritizes minimizing immediate financial loss for the insurer by denying the claim outright, without a proper legal and factual investigation into the non-disclosure, is ethically and regulatorily unsound. This demonstrates a lack of commitment to the principles of utmost good faith and fair dealing, which are fundamental to insurance contracts. It also ignores the legal framework that provides specific remedies based on the nature of the breach. Professional reasoning. Professionals should adopt a structured decision-making framework that begins with understanding the contractual obligations and regulatory requirements. This involves 1. Factual investigation. Gather all relevant facts concerning the non-disclosure. 2. Legal analysis. Interpret the policy wording and apply the relevant legislation, e.g., Insurance Act 2015 in the UK and case law. 3. Materiality assessment. Determine if the non-disclosed information was material to the risk. 4. Intent assessment. Evaluate whether the non-disclosure was innocent, negligent, or fraudulent. 5. Remedy determination. Based on the above, identify the proportionate remedy available to the insurer under the law. 6. Communication. Clearly communicate the findings and proposed course of action to all relevant parties, adhering to principles of transparency and fairness. Question 4. The monitoring system demonstrates a consistent trend of increasing claim severity and a decline in investment income, leading to a solvency ratio that is approaching regulatory minimums. What is the most appropriate governance response for the RRG's Board of Directors to ensure continued compliance and member confidence? Option A. Delegate the entire responsibility for addressing the solvency issues to an external risk management firm, accepting their recommendations without independent board verification or member communication. Option B. Conceal the solvency concerns from the membership to avoid panic and focus solely on internal cost-cutting measures without disclosing the full financial picture. Option C. Immediately inform the membership of the solvency concerns, detailing the contributing factors and outlining a proposed plan of action that includes potential adjustments to underwriting and risk management strategies, subject to board and member review. Option D. Implement significant, unilateral changes to the RRG's dividend policy and member benefits to shore up capital, without prior consultation with the membership or detailed board discussion on the long-term implications. The correct answer is C. Immediately inform the membership of the solvency concerns, detailing the contributing factors and outlining a proposed plan of action that includes potential adjustments to underwriting and risk management strategies, subject to board and member review. Explanation. This scenario is professionally challenging because it requires the RRG's Board of Directors to balance the fiduciary duty owed to the members with the operational realities of managing risk and ensuring solvency. The core tension lies in upholding the RRG's cooperative structure and member-centric purpose, while adhering to stringent regulatory capital and governance requirements designed to protect policyholders. Careful judgment is required to interpret the monitoring system's findings within the context of the applicable regulatory framework, and to implement appropriate corrective actions that are both effective and compliant. The correct approach involves a proactive and transparent engagement with the RRG's members regarding the identified solvency concerns. This includes clearly communicating the nature of the risks, the potential impact on future dividends or premiums, and the proposed remedial actions. This approach aligns with the principles of good governance for a risk retention group, RRG, which emphasize member participation and accountability. Specifically, under the relevant U.S. state-based insurance regulatory framework. As this exam typically focuses on U.S. RRG regulation, RRGs are subject to solvency standards and reporting requirements akin to traditional insurers. The board has a fiduciary duty to ensure the RRG's financial stability. Transparency with members about solvency issues is not only ethically sound, but also often implicitly or explicitly required by state insurance departments to ensure the continued viability of the RRG and the protection of its policyholders. This proactive communication allows members to understand the situation and potentially participate in solutions, reinforcing the cooperative nature of the RRG. An incorrect approach would be to downplay or conceal the solvency concerns from the members. This failure to disclose material information violates the board's fiduciary duty to act in the best interests of the members and to ensure the RRG's long-term health. Such concealment could lead to regulatory sanctions, including fines or even revocation of the RRG's charter, as state insurance departments expect accurate and timely reporting of financial conditions. Furthermore, it erodes trust between the RRG and its members, undermining the cooperative model. Another incorrect approach would be to implement significant changes to the RRG's risk appetite or underwriting guidelines without adequate member consultation or board approval, especially if these changes materially alter the RRG's fundamental purpose or the benefits provided to members. While the board has the authority to manage the RRG's operations, drastic unilateral changes that impact member benefits or the core business model without proper governance processes can be seen as a breach of duty and potentially violate the RRG's charter or operating agreement, which are subject to regulatory oversight. This could also lead to member dissatisfaction and potential legal challenges. A third incorrect approach would be to solely rely on external consultants to develop and implement solutions without sufficient internal oversight or understanding by the board. While expert advice is valuable, the ultimate responsibility for the RRG's governance and solvency rests with the board of directors. Delegating critical decision-making without proper due diligence and understanding can lead to misaligned strategies or a failure to address the root causes of the solvency issues, potentially resulting in regulatory noncompliance and continued financial instability. The professional decision-making process for similar situations should involve a thorough review of the monitoring system's findings, consultation with legal and actuarial experts, and a clear understanding of the board's fiduciary responsibilities under the applicable regulatory framework. The board must then develop a comprehensive plan that addresses the solvency issues, ensuring it is both compliant with regulations and transparent to the membership. Open communication and collaborative problem-solving with members, where appropriate, are crucial for maintaining the integrity and sustainability of the RRG. Question 5. Regulatory review indicates that a company is proposing significant process optimization to reduce operational costs. The proposed changes involve streamlining workflows and automating certain manual checks that are currently part of a layered engineering control system designed to prevent equipment malfunction. The risk manager must determine the most appropriate course of action to ensure compliance with advanced risk financing and transfer regulations. Which of the following approaches best aligns with these regulatory requirements? Option A. Prioritize the cost savings from the process optimization and implement the changes, deferring any detailed review of engineering controls until a specific incident occurs. Option B. Conduct a comprehensive risk assessment to evaluate the impact of the proposed process optimization on the effectiveness and reliability of the existing engineering controls, seeking expert validation before implementation. Option C. Proceed with the process optimization as planned, assuming that the automation will inherently improve efficiency and that existing safety protocols will remain sufficient. Option D. Implement the process optimization with a plan to review the engineering controls retrospectively after a period of operation to identify any unforeseen issues. The correct answer is C. Proceed with the process optimization as planned, assuming that the automation will inherently improve efficiency and that existing safety protocols will remain sufficient. Explanation. This scenario presents a professional challenge because it requires a risk manager to balance the immediate cost-saving pressures from senior management with the long-term imperative of maintaining robust engineering controls to prevent catastrophic operational failures. The challenge lies in discerning when a proposed process optimization, while seemingly efficient, might inadvertently compromise the integrity or effectiveness of critical safety systems, thereby increasing the likelihood of a significant risk event. Careful judgment is required to ensure that financial objectives do not override fundamental risk management principles and regulatory compliance. The correct approach involves a thorough, multifaceted risk assessment that explicitly considers the impact of the proposed process optimization on existing engineering controls. This includes evaluating potential failure modes, the adequacy of residual risk mitigation, and the alignment with regulatory requirements for safety and operational integrity. The justification for this approach stems directly from the regulatory framework governing advanced risk financing and transfer, which mandates a proactive and comprehensive approach to risk identification, assessment, and control. Specifically, regulations emphasize the need for controls to be effective, reliable, and demonstrably capable of preventing or mitigating significant harm. Prioritizing the integrity of engineering controls ensures compliance with these overarching principles and protects against potential financial, reputational, and human costs associated with operational failures. An incorrect approach would be to implement the process optimization solely based on projected cost savings, without a rigorous evaluation of its impact on engineering controls. Its failure to adequately assess risk is a direct contravention of regulatory expectations. Another incorrect approach is to assume that existing controls will automatically remain effective after process changes, without specific validation. This assumption overlooks the interconnectedness of operational processes and safety systems, leading to potential blind spots in risk management. Furthermore, deferring the assessment of engineering control impact to a later stage, or relying on anecdotal evidence of control effectiveness, represents a significant ethical and regulatory lapse. Such actions demonstrate a disregard for due diligence and a failure to uphold the professional responsibility to manage risks effectively and in accordance with established standards. Professionals should adopt a decision-making framework that prioritizes a systematic and evidence-based approach to risk management. This involves 1. Clearly defining the scope of the proposed change and its potential interactions with existing risk control measures. 2. Conducting a detailed risk assessment that specifically examines the impact on engineering controls, including failure mode and effects analysis, FME, where appropriate. 3. Consulting relevant technical experts and regulatory guidance to ensure all compliance obligations are met. 4. Documenting the assessment process, findings, and decisions, including any residual risks and the rationale for their acceptance. 5. Establishing clear communication channels with senior management to articulate the risk implications of proposed optimizations and advocate for decisions that uphold safety and compliance. Question 6. The assessment process reveals that a potential client is seeking a comprehensive, multi-year insurance program covering property, business interruption, and product liability for a global manufacturing operation. The client desires a single, integrated policy structure with a unified premium and claims handling process. What is the most appropriate approach to risk assessment for this complex program? Option A. Develop an integrated risk assessment model that quantifies potential losses across all lines of business, considering interdependencies, correlation of risks, and projecting claims development over the multi-year program term under various economic and operational scenarios. Option B. Conduct a detailed, line-by-line actuarial analysis of historical claims data for each coverage type, aggregating the results to determine the overall program premium, while assuming minimal correlation between the lines. Option C. Focus primarily on the client's current financial strength and their ability to absorb potential losses, using this as the primary driver for premium setting, with less emphasis on detailed claims forecasting. Option D. Utilize a standard industry pricing benchmark for each coverage type and apply a modest discount for the multi-year, multi-line commitment without conducting in-depth, bespoke risk modeling. Correct answer is B. Conduct a detailed, line-by-line actuarial analysis of historical claims data for each coverage type, aggregating the results to determine the overall program premium, while assuming minimal correlation between the lines. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how to assess and price complex, multi-year risk financing programs that span multiple lines of business. The inherent uncertainty in projecting future claims costs, market conditions, and regulatory changes over an extended period, coupled with the interdependencies between different insurance classes, demands a robust and forward-looking risk assessment methodology. Professionals must balance the need for accurate pricing to ensure solvency and profitability with the competitive pressures to offer attractive terms to clients. The correct approach involves a comprehensive, integrated risk assessment that considers the correlation and aggregation of risks across all covered lines of business and over the entire program duration. This methodology acknowledges that the impact of a single event or trend can cascade across multiple lines, and that the long-term nature of the program necessitates forecasting beyond immediate historical data. This approach aligns with regulatory expectations for prudent risk management and capital adequacy, ensuring that the insurer has sufficient resources to meet its obligations under various scenarios. It also reflects ethical obligations to policyholders to provide coverage that is both affordable and sustainable. An incorrect approach that focuses solely on the historical performance of individual lines of business in isolation fails to account for the potential for correlated losses and the aggregate impact on the insurer's overall financial health. This oversight can lead to underpricing and inadequate reserving, potentially jeopardizing the insurer's solvency and violating regulatory requirements for sound financial management. Another incorrect approach that prioritizes short-term profitability over long-term sustainability by offering aggressive pricing based on optimistic, unvalidated assumptions about future claims development is also professionally unacceptable. This can lead to significant financial strain if claims emerge at higher than expected levels, potentially resulting in regulatory intervention and reputational damage. A third incorrect approach that relies heavily on simplistic actuarial models without incorporating qualitative risk factors or forward-looking scenario analysis neglects the dynamic nature of the risk landscape. This can result in a failure to identify emerging risks or to adequately capture the impact of external factors such as economic downturns or changes in litigation trends, leading to an inaccurate assessment of the program's true risk profile. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's business and the specific risks associated with each line of coverage. This should be followed by a detailed analysis of historical data, but critically, this data must be used to inform forward-looking projections, not as a sole determinant of future outcomes. The assessment must explicitly model interdependencies between lines, consider a range of plausible future scenarios, including stress tests, and incorporate expert judgment on qualitative factors. Regulatory guidelines on reserving, capital adequacy, and risk management should be integrated throughout the process, ensuring that the final pricing and program structure are both commercially viable and compliant. Question 7. The performance metrics show a significant variance between the initial estimated premium for a retrospectively rated workers' compensation policy and the projected final premium based on current loss development trends. Which of the following represents the most appropriate approach for accounting and financial reporting? Option A. Recognize a contingent liability for the potential increase in premium, but do not adjust the current period's expense until the final premium is billed. Option B. Capitalize the initial estimated premium as a prepaid expense and amortize it over the policy period, irrespective of loss development. Option C. Adjust the financial statements to reflect the projected final premium, including any potential increase or decrease, and disclose the nature of the retrospective rating agreement and its potential impact on future financial performance. Option D. Continue to account for the insurance expense based solely on the initial estimated premium, as the final premium is not yet definitively determined. The correct answer is C. Adjust the financial statements to reflect the projected final premium, including any potential increase or decrease, and disclose the nature of the retrospective rating agreement and its potential impact on future financial performance. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of retrospectively rated insurance contracts and their implications for financial reporting and risk management, particularly in the context of regulatory compliance. The challenge lies in accurately assessing the financial impact of such policies and ensuring that the accounting treatment reflects the true economic substance of the arrangement, thereby avoiding misrepresentation to stakeholders and regulators. Careful judgment is required to interpret the policy terms and their potential future financial outcomes. The correct approach involves a thorough review of the specific retrospective rating agreement, including its premium adjustment mechanisms, loss development factors, and any caps or floors on the final premium. This approach aligns with best practices by ensuring that the financial statements accurately reflect the potential liabilities and assets arising from the insurance contract. From a regulatory perspective, this is crucial for compliance with accounting standards, e.g., IFRS 17 or relevant U.S. GAAP equivalents depending on the exam-specified jurisdiction, which mandate that insurance contracts are accounted for in a way that reflects their true economic nature and the risks transferred. Ethically, it upholds transparency and fairness to investors, creditors, and other stakeholders by providing a true and fair view of the company's financial position. An incorrect approach would be to simply book the initial estimated premium without considering the potential for significant retrospective adjustments. This fails to comply with accounting principles that require the recognition of contingent liabilities or assets arising from such contracts. It can lead to an overstatement or understatement of expenses and liabilities, misrepresenting the company's profitability and financial health. This also violates the ethical duty of transparency and can lead to regulatory sanctions for financial misstatement. Another incorrect approach would be to ignore the potential impact of future loss development on the premium, assuming the initial premium will be the final premium. This overlooks a fundamental characteristic of retrospectively rated policies and can result in a failure to adequately accrue for potential future premium increases or to recognize potential premium refunds. This is a failure in risk management and financial prudence, as it does not account for the full spectrum of potential financial outcomes. A further incorrect approach might be to apply a generic accounting treatment for insurance without specific consideration for the retrospective rating features. This demonstrates a lack of understanding of the specific contract type and its unique accounting implications, leading to an inaccurate financial representation. The professional decision-making process for similar situations should involve 1. Deeply understanding the specific terms and conditions of the retrospectively rated insurance policy. 2. Consulting with accounting and actuarial experts to model potential future premium adjustments based on loss development. 3. Applying the relevant accounting standards rigorously, ensuring that all potential financial impacts are appropriately recognized and disclosed. 4. Maintaining open communication with auditors and regulators regarding the accounting treatment of such complex insurance arrangements. Question 8. Process analysis reveals that a firm operating within the UK financial services regulatory framework is experiencing significant market volatility and a tightening of credit markets, leading to increased funding costs. The firm's current contingency funding plan was developed based on historical stress scenarios. Given these evolving market conditions, which of the following actions best aligns with the regulatory expectations for advanced risk financing and transfer concerning contingency funding? Option A. Proactively review and update the contingency funding plan to incorporate the current market stress and assess its adequacy, potentially identifying new sources of contingent liquidity or adjusting existing drawdown plans. Option B. Continue to operate under the existing contingency funding plan, assuming that historical stress scenarios are still representative of potential future events and that the current market volatility is temporary. Option C. Immediately reduce the firm's holdings of liquid assets to conserve capital, as the increased funding costs are impacting profitability. Option D. Postpone any review or revision of the contingency funding plan until market conditions stabilize and return to pre-volatility levels. The correct answer is A. Proactively review and update the contingency funding plan to incorporate the current market stress and assess its adequacy, potentially identifying new sources of contingent liquidity or adjusting existing drawdown plans. Explanation: this scenario is professionally challenging because it requires a firm to balance the immediate financial pressures of a market downturn with its long-term regulatory obligations to maintain adequate contingency funding. The firm's management must exercise sound judgment to ensure that any adjustments to contingency funding strategies do not compromise its ability to meet its obligations to clients and regulators, particularly during periods of stress. The correct approach involves proactively reviewing and, if necessary, adjusting the contingency funding plan in response to the identified market stress, while ensuring that the revised plan remains compliant with the relevant regulatory framework. This approach is correct because it demonstrates a commitment to robust risk management and regulatory adherence. Specifically, it aligns with the principles of prudential regulation that mandate firms to maintain sufficient liquidity and capital to withstand adverse market conditions. The regulatory framework for advanced risk financing and transfer, as per the specified exam jurisdiction, assumed to be UK/SISI for this example, emphasizes the importance of a dynamic and responsive contingency funding plan that is regularly tested and updated. This proactive stance ensures the firm can continue to operate and meet its obligations, thereby protecting its clients and the wider financial system. An incorrect approach would be to solely rely on historical data without considering the current market stress. This fails to acknowledge the forward-looking nature of contingency planning and the regulatory expectation that firms anticipate and prepare for plausible stress scenarios. It also ignores the specific guidance within the regulatory framework that requires plans to be tested against current and foreseeable risks. Another incorrect approach would be to significantly reduce contingency funding levels to conserve capital during the downturn, without a thorough assessment of the impact on liquidity and the firm's ability to meet its obligations under stressed conditions. This would likely violate regulatory requirements for maintaining adequate liquidity buffers and could expose the firm to significant operational and reputational risk, as well as potential regulatory sanctions. The regulatory framework typically sets minimum liquidity coverage ratios and other prudential requirements that cannot be arbitrarily reduced based on short-term market sentiment. A further incorrect approach would be to delay any review or adjustment of the contingency funding plan until the market stress has fully subsided. This passive stance is contrary to the principles of effective risk management and regulatory compliance. Regulators expect firms to be agile and to take timely action to address emerging risks. Delaying action could mean the firm is inadequately prepared if the stress intensifies or persists, leading to a breach of regulatory requirements and potential financial distress. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client protection. This involves 1. Understanding the specific regulatory requirements for contingency funding in the relevant jurisdiction. 2. Continuously monitoring market conditions and assessing their potential impact on the firm's liquidity and funding needs. 3. Regularly reviewing and stress testing the contingency funding plan to ensure its effectiveness under various scenarios. 4. Being prepared to implement predefined contingency measures promptly when triggered by market events or internal assessments. 5. Documenting all reviews, assessments, and decisions related to the contingency funding plan for audit and regulatory purposes. Question 9. Research into the regulatory treatment of industry loss warranties, ILWA, by UK-regulated insurers indicates that their impact on solvency capital requirements, SCR, can be complex. Considering the Solvency Roman II framework as implemented by the Prudential Regulation Authority, PRA, which of the following best describes the appropriate approach for an insurer to reflect the risk mitigation benefits of an ILW in its SCR calculation? Option A. The insurer should ignore the ILW in its SCR calculation, as it is an off-balance sheet instrument and therefore has no direct impact on regulatory capital. Option B. The insurer should treat the ILW solely as an investment asset on its balance sheet and not consider its impact on the SCR, as it is a derivative contract. Option C. The insurer should automatically deduct the full notional amount of the ILW from its total SCR, assuming it provides a complete capital offset regardless of trigger events or correlation with actual losses. Option D. The insurer should assess the ILW's terms and conditions to determine if it effectively transfers a specific risk that contributes to the SCR, and if so, quantify the reduction in SCR in accordance with PRA guidelines for risk mitigation techniques. The correct answer is D. The insurer should assess the ILW's terms and conditions to determine if it effectively transfers a specific risk that contributes to the SCR, and if so, quantify the reduction in SCR in accordance with PRA guidelines for risk mitigation techniques. Explanation. This scenario is professionally challenging because it requires a deep understanding of how industry loss warranties, ILWA, interact with regulatory capital requirements and solvency frameworks, specifically within the context of the UK's prudential regulatory regime for insurance and reinsurance. The challenge lies in accurately assessing the impact of an ILW on a firm's solvency position, particularly when considering the potential for basis risk and the nuances of how such a contract is treated for regulatory capital purposes. Firm must not only understand the mechanics of the ILW, but also its implications for meeting the stringent solvency capital requirements, SCR, mandated by the Prudential Regulation Authority, PRA, under the Solvency Roman II framework. The professional judgment required is to determine the most appropriate method for reflecting the ILW's risk mitigation in regulatory reporting, ensuring compliance and accurate capital assessment. The correct approach involves a thorough analysis of the ILW's terms and conditions, specifically its trigger event and payout structure, and then evaluating how this aligns with the firm's risk profile and the Solvency Roman II SCR calculation. This includes assessing whether the ILW effectively transfers a specific risk that would otherwise contribute to the SCR, and if so, how the reduction in risk is quantified and recognized under the Solvency Roman II framework. This often involves considering whether the ILW can be treated as a risk mitigation technique that reduces the SCR, or if it needs to be accounted for differently, perhaps as an asset or a contingent liability, depending on its structure and the specific regulatory guidance. The regulatory justification stems from the PRA's Solvency Roman II requirements, which demand that firms hold adequate capital to cover their risks. ILWA, if structured appropriately and documented correctly, can be used to reduce the SCR by mitigating specific risks, such as catastrophe risk. The key is demonstrating to the regulator that the ILW provides a genuine economic benefit in terms of risk reduction that is reflected in the capital calculation. An incorrect approach would be to assume that any ILW automatically reduces the SCR without a detailed assessment of its terms and regulatory eligibility. For instance, simply deducting the notional amount of the ILW from the SCR without considering the trigger. The correlation of the ILW payout with the firm's actual losses and the specific Solvency Roman II rules for risk mitigation would be a regulatory failure. This overlooks the potential for basis risk, where the ILW payout might not perfectly match the firm's own losses, and the PRA's requirement for risk mitigation techniques to be demonstrably effective and legally enforceable. Another incorrect approach would be to treat the ILW solely as a financial instrument, without considering its risk transfer function in the context of solvency capital. This could lead to an inaccurate representation of the firm's risk profile and capital adequacy, potentially violating the principle of prudent capital management and accurate solvency reporting under Solvency Roman II. The regulatory failure here is a misapplication of Solvency Roman II principles, failing to recognize the ILW's intended purpose as a risk mitigation tool for solvency capital purposes. A professional decision-making process for similar situations should involve a systematic review of the ILW documentation, a clear understanding of the firm's risk exposures, and a detailed application of the Solvency Roman II framework as interpreted by the PRA. This includes consulting relevant PRA supervisory statements, technical specifications, and potentially seeking expert advice on the regulatory treatment of such instruments. The firm must be able to articulate and justify its approach to the regulator, demonstrating that the ILW's impact on solvency capital is accurately and prudently reflected. Question 10. To address the challenge of a client requesting insurance coverage for a business operation while intentionally omitting a known, significant operational risk from the insurer to secure a lower premium, what is the most appropriate course of action for a risk financing professional operating under UK regulatory frameworks and SISI guidelines? Option A. Recommend to the client that they phrase the disclosure of the risk in a way that downplays its potential impact, without explicitly stating the full extent of the risk. Option B. Proceed with the insurance application as requested by the client, assuming the insurer will discover the risk during their own due diligence. Option C. Suggest the client seek alternative, non-insurance risk financing solutions that do not require disclosure of this specific risk. Option D. Advise the client that all material risks must be fully and accurately disclosed to the insurer to ensure the validity of the insurance contract and compliance with regulatory obligations. The correct answer is D. Advise the client that all material risks must be fully and accurately disclosed to the insurer to ensure the validity of the insurance contract and compliance with regulatory obligations. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial interests and the insurer's obligation to accurately assess and price risk. The client's desire to secure coverage at a lower premium by downplaying a known, material risk creates an ethical and regulatory tightrope for the risk financing professional. Careful judgment is required to uphold professional integrity and comply with regulatory mandates concerning disclosure and fair representation. The correct approach involves clearly communicating to the client that the undisclosed risk is material and must be disclosed to the insurer. This approach upholds the principle of utmost good faith, uberrimi fidei, which is a cornerstone of insurance contracts. By insisting on full disclosure, the professional ensures that the insurer can accurately underwrite the risk, set an appropriate premium, and avoid potential claims disputes or policy rescissions later. This aligns with regulatory requirements that mandate honest and complete disclosure of all material facts by the insured. It also reflects the professional's duty to act with integrity and competence, prioritizing regulatory compliance and ethical conduct over short-term client satisfaction or potential commission gains. An incorrect approach would be to proceed with the insurance application without disclosing the known risk. This failure to disclose a material fact constitutes a breach of the duty of utmost good faith. Regulators would view this as misrepresentation or non-disclosure, which can lead to policy voidance, denial of claims, and disciplinary action against the professional. Another incorrect approach would be to advise the client on how to phrase the disclosure in a way that minimizes its perceived impact, without fully disclosing its significance. This could be construed as facilitating deception, undermining the insurer's ability to assess risk accurately, and violating professional standards of honesty and transparency. The professional decision-making process for similar situations should involve a clear understanding of the duty of utmost good faith, the definition of material facts, and the regulatory consequences of non-disclosure. Professionals should always prioritize transparency and honesty with both the client and the insurer. If a client insists on withholding material information, the professional should explain the risks of non-disclosure, including policy invalidation and potential legal repercussions, and be prepared to withdraw from the engagement if the client's wishes conflict with regulatory and ethical obligations. Question 11. Analysis of a firm's risk register and associated heat map reveals a number of identified risks. Which approach to further developing these tools would best satisfy the requirements of a robust risk management framework for regulatory compliance and effective risk financing? Option A. Simply listing all identified risks in the register and ensuring the heat map visually represents their perceived importance. Option B. Quantifying the potential financial and operational impact of each risk against defined thresholds and aligning these with the firm's risk appetite. Option C. Prioritizing risks based on the frequency of their occurrence as indicated in historical incident reports. Option D. Assigning qualitative severity ratings to risks without attempting to quantify potential financial losses. The correct answer is B. Quantifying the potential financial and operational impact of each risk against defined thresholds and aligning these with the firm's risk appetite. Explanation. This scenario is professionally challenging because it requires a risk manager to move beyond a superficial understanding of risk registers and heat maps to a deeper, more strategic application that directly informs capital allocation and regulatory compliance. The challenge lies in translating qualitative risk assessment into actionable insights that satisfy the rigorous demands of the advanced risk financing and transfer exam's specified regulatory framework, which emphasizes robust governance and prudent risk management. A superficial approach risks misrepresenting the firm's risk profile, leading to inefficient capital deployment and potential regulatory censure. The correct approach involves a detailed impact assessment that quantifies the potential financial and operational consequences of identified risks, aligning these with the firm's risk appetite and capital adequacy requirements. This method is correct because it directly addresses the core purpose of risk registers and heat maps, to provide a clear, prioritized view of risks that enables informed decision-making. Specifically, by assessing the impact of each risk against defined thresholds, e.g., probability and severity of financial loss, operational disruption, reputational damage, the risk manager can accurately identify the most significant threats. This detailed impact assessment is crucial for demonstrating to regulators that the firm has a sophisticated understanding of its risk exposures and has implemented appropriate mitigation and financing strategies, aligning with principles of sound financial management and regulatory oversight. An incorrect approach that focuses solely on the frequency of risks without a thorough assessment of their potential impact fails to provide the necessary depth for effective risk financing and capital allocation. This is ethically and regulatorily unsound, as it can lead to underestimation of critical risks, leaving the firm inadequately protected against severe events. Another incorrect approach that prioritizes risks based on subjective qualitative descriptions without attempting to quantify potential losses or operational disruptions neglects the quantitative rigor expected by regulatory bodies. This can result in misallocation of resources, where high-impact, low-frequency events might be overlooked in favor of more frequent but less damaging ones. A third incorrect approach that merely lists risks in a register without linking them to potential financial outcomes or strategic objectives fails to leverage the risk register as a dynamic management tool. This approach is deficient because it does not facilitate the identification of risks that warrant specific financing or transfer mechanisms, thereby undermining the firm's ability to manage its overall risk-adjusted performance and meet regulatory expectations for proactive risk management. The professional decision-making process for similar situations should involve a structured methodology. First, clearly define the scope and objectives of the risk assessment in alignment with the firm's strategic goals and regulatory obligations. Second, identify and document all relevant risks, ensuring a comprehensive and systematic process. Third, for each identified risk, conduct a detailed impact assessment, considering financial, operational, and reputational consequences, and where possible, quantify these impacts against defined metrics. Fourth, use the heat map to visually represent the prioritized risks based on their assessed impact and likelihood, facilitating clear communication. Fifth, critically evaluate the findings to inform risk financing and transfer decisions, ensuring that these decisions are aligned with the firm's risk appetite and capital adequacy. Finally, establish a process for regular review and update of the risk register and heat map to reflect changes in the risk landscape and the effectiveness of mitigation strategies. Question 12. The investigation demonstrates that a commercial property insurance policy contained a coinsurance clause requiring the policyholder to insure the property to at least 80% of its actual cash value to avoid a penalty. Following a partial loss, the insurer calculated the claim payout based on a formula that did not fully account for the policyholder's actual insurance coverage relative to the 80% threshold, resulting in a reduced payout. Which approach to resolving this discrepancy best aligns with regulatory expectations for fair claims handling and accurate policy application? Option A. Apply a standardized penalty percentage to the loss amount, irrespective of the precise coinsurance calculation, to expedite the claims process. Option B. Recalculate the claim payout by precisely applying the coinsurance formula, comparing the actual insurance carried to the required 80% of the property's actual cash value, and adjusting the payout accordingly to reflect the correct coinsurance penalty or lack thereof. Option C. Adjust the property's actual cash value upwards to meet the 80% coinsurance requirement, thereby avoiding a penalty on the current loss. Option D. Waive the coinsurance penalty entirely, assuming the policyholder acted in good faith to maintain a positive client relationship. The correct answer is B. Recalculate the claim payout by precisely applying the coinsurance formula, comparing the actual insurance carried to the required 80% of the property's actual cash value, and adjusting the payout accordingly to reflect the correct coinsurance penalty or lack thereof. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of how coinsurance clauses operate within the context of a specific regulatory framework, particularly concerning the insurer's duty of utmost good faith and the accurate representation of policy terms. The core of the challenge lies in ensuring that the coinsurance provision, designed to promote risk sharing and prevent underinsurance, is applied in a manner that is both compliant with regulatory expectations and fair to the policyholder. Misinterpreting or misapplying the coinsurance clause can lead to disputes, financial losses for either party, and potential regulatory scrutiny for the insurer. Careful judgment is required to balance the insurer's need for adequate premium and risk management with the policyholder's expectation of clear and equitable coverage. The correct approach involves a thorough and accurate calculation of the coinsurance penalty, taking into account the policy's agreed-upon value, the required insurance amount based on the coinsurance percentage, and the actual amount of insurance carried. This approach is correct because it directly adheres to the principles of accurate policy administration and fair claims handling, which are fundamental to regulatory compliance and ethical conduct in the insurance industry. Specifically, it ensures that the policyholder is not unfairly penalized due to a misunderstanding or misapplication of the coinsurance clause, and that the insurer fulfills its contractual obligations based on a correct interpretation of the policy terms and applicable regulations. This aligns with the regulatory expectation that insurers act with utmost good faith and provide clear, unambiguous policy terms and conditions. An incorrect approach that involves applying a simplified or arbitrary penalty without a precise calculation of the coinsurance shortfall fails to meet regulatory standards. This is because it deviates from the established methodology for calculating coinsurance penalties, potentially leading to an overcharge or underpayment of claims, which can be construed as unfair or deceptive practice. Another incorrect approach, which is to waive the coinsurance penalty entirely without a valid, documented reason or a clear policy provision allowing for such a waiver, also presents regulatory and ethical issues. This could be seen as inconsistent application of policy terms, potentially creating an unfair advantage for one policyholder over others, and undermining the principle of equitable treatment. Furthermore, failing to clearly communicate the implications of the coinsurance clause to the policyholder during the underwriting process or at renewal, thereby leading to a situation where the policyholder is unaware of the potential penalty, constitutes a failure in the duty of disclosure and transparency, which is a cornerstone of regulatory oversight. Professional decision-making in similar situations requires a systematic process. First, A thorough review of the policy wording and the specific coinsurance clause is essential. Second, understanding the applicable regulatory framework and any guidance issued by the relevant supervisory authority regarding coinsurance is paramount. Third, accurate calculation of the coinsurance penalty, using the agreed-upon values and percentages, must be performed. Fourth, if there is any ambiguity or potential for dispute, seeking clarification from legal or compliance departments, or consulting with industry best practices, is advisable. Finally, clear and transparent communication with the policyholder regarding the application of the coinsurance clause and any resulting adjustments to claims is crucial for maintaining trust and ensuring regulatory compliance. Question 13. During the evaluation of a proposed captive insurance company structure for a UK-based multinational corporation, which of the following approaches best aligns with the regulatory framework for advanced risk financing and transfer, specifically considering the requirements of the Prudential Regulation Authority (PRA) and the Financial Conduct Authority (FCA) under Solvency II? Option A. Prioritizing the captive's ability to achieve significant tax efficiencies for the parent company, with a secondary consideration for operational setup. Option B. Conducting a comprehensive assessment of the captive's business plan, capital adequacy, governance, and alignment with the parent's risk appetite, ensuring demonstrable compliance with Solvency II requirements and proactive engagement with UK regulators. Option C. Assuming regulatory approval based on the captive's intended function of transferring specific insurable risks from the parent, without detailed substantiation of the economic substance and arm's-length nature of the proposed reinsurance arrangements. Option D. Focusing on the captive's operational simplicity and ease of management, assuming that its role as a pure risk transfer vehicle for the parent will inherently satisfy regulatory requirements. The correct answer is A. Prioritizing the captive's ability to achieve significant tax efficiencies for the parent company, with a secondary consideration for operational setup. Explanation. This scenario is professionally challenging because it requires a deep understanding of the regulatory framework governing captive insurance companies within the specified jurisdiction, specifically the UK's regulatory environment as overseen by the Prudential Regulation Authority (PRA) and the Financial Conduct Authority (FCA). The core challenge lies in accurately assessing the impact of a proposed captive structure on the parent company's risk management framework and its compliance with Solvency II requirements, without resorting to simplistic or misapplied regulatory interpretations. Careful judgment is required to distinguish between genuine risk mitigation and potential regulatory arbitrage. The correct approach involves a comprehensive assessment of the captive's operational feasibility, financial solvency, and alignment with the parent company's overall risk appetite and strategic objectives, all within the stringent confines of UK insurance regulation. This includes a thorough review of the captive's business plan, capital adequacy projections, governance structure, and the proposed reinsurance arrangements. Specifically, it necessitates demonstrating to the regulators that the captive will not undermine the parent's financial stability or create undue systemic risk, and that it meets all capital and liquidity requirements under Solvency II. The regulatory justification for this approach is rooted in the PRA's and FCA's mandate to ensure the safety and soundness of the insurance market and to protect policyholders. A robust assessment ensures that the captive is a legitimate risk financing tool and not a mechanism to circumvent regulatory oversight or capital requirements. An incorrect approach that focuses solely on the potential tax advantages of a captive, without adequately addressing the regulatory capital and solvency implications, fails to meet the fundamental requirements of UK insurance law. This approach is ethically flawed as it prioritizes financial gain over regulatory compliance and prudent risk management, potentially exposing the parent company and its stakeholders to unforeseen financial distress. Such a focus would likely be met with significant scrutiny and rejection by the PRA and FCA, as it demonstrates a misunderstanding of their supervisory objectives. Another incorrect approach that prioritizes the captive's operational simplicity over robust governance and internal controls is also professionally unacceptable. While efficiency is desirable, it cannot come at the expense of regulatory compliance. The PRA and FCA expect all regulated entities, including captives, to have strong governance frameworks, effective risk management systems, and appropriate internal controls. Neglecting these aspects, even for the sake of simplicity, creates significant regulatory risk and could lead to supervisory intervention. A third incorrect approach that assumes regulatory approval based on the captive's intended use as a pure risk transfer mechanism for the parent, without detailed substantiation and adherence to specific Solvency Roman II provisions for intragroup transactions, is also flawed. Regulators require clear evidence and robust documentation to support such arrangements, demonstrating that they are conducted on an arm's-length basis and do not create artificial capital structures. A superficial understanding of risk transfer without the necessary regulatory rigor will not suffice. The professional decision-making process for similar situations should involve a structured, risk-based approach. First, clearly define the objectives of establishing a captive, ensuring they align with the parent company's strategic risk management goals. Second, conduct a thorough due diligence of the regulatory landscape, identifying all applicable laws, regulations, and supervisory expectations. Third, develop a comprehensive business plan for the captive that addresses operational, financial, governance, and compliance aspects, with a particular focus on capital adequacy and solvency under Solvency Roman II. Fourth, engage proactively with the relevant regulators, PRA and FCA, to discuss the proposed structure and seek guidance. Finally, ensure that the captive is managed and operated in a manner that is consistent with its approved business plan and ongoing regulatory requirements. Question 14. Risk assessment procedures indicate that a newly implemented preventative risk control technique, designed to mitigate operational errors in a financial services firm regulated by the FCA, is not achieving its intended reduction in error rates. The implementation team reports significant practical challenges in adhering to the prescribed steps of the technique due to existing workflow constraints. What is the most appropriate course of action for the firm's risk management function? Option A. Immediately discontinue the use of the new control technique and revert to the previous, less effective risk mitigation measures while a new technique is sought. Option B. Continue with the current implementation of the control technique, assuming that the operational teams will eventually adapt and the error rates will naturally decrease over time. Option C. Conduct a thorough review of both the original risk assessment for the identified operational risk and the practical implementation of the control technique, identifying specific points of failure and proposing adjustments to either the assessment or the implementation process. Option D. Focus solely on retraining the operational staff on the existing control technique, without investigating the underlying workflow constraints that are hindering its effective application. The correct answer is C. Conduct a thorough review of both the original risk assessment for the identified operational risk and the practical implementation of the control technique, identifying specific points of failure and proposing adjustments to either the assessment or the implementation process. Explanation. This scenario presents a professional challenge because the implementation of a chosen risk control technique is encountering unforeseen practical difficulties that directly impact its effectiveness. The firm must balance the theoretical soundness of the chosen technique with the reality of its operational execution, all while adhering to the regulatory framework governing risk management. Careful judgment is required to determine if the issue lies with the technique itself, its implementation, or the underlying risk assessment. The correct approach involves a systematic review of the risk assessment and the control technique's implementation to identify the root cause of the ineffectiveness. This requires a thorough understanding of the firm's operational environment and the specific risks being managed. Regulatory guidance, such as that provided by the Financial Conduct Authority, FCA in the UK, emphasizes the need for firms to have robust risk management systems and controls that are effective in practice. This includes ensuring that risk mitigation strategies are not merely documented, but are actively and successfully implemented. The approach of re-evaluating the risk assessment and implementation process aligns with the FCA's expectations for ongoing monitoring and adaptation of risk controls to ensure they remain fit for purpose. An incorrect approach would be to simply abandon the control technique without a proper investigation. This fails to address the underlying issue and could leave the firm exposed to the identified risk. It also demonstrates a lack of due diligence and a failure to meet the FCA's requirements for effective risk management. Another incorrect approach would be to proceed with the ineffective control, assuming it will eventually work or that minor deviations are acceptable. This is a direct contravention of regulatory expectations, as it implies a lack of commitment to genuine risk mitigation and could lead to regulatory sanctions for failing to manage risks adequately. Furthermore, making assumptions about the effectiveness of controls without evidence is professionally unsound and ethically questionable, as it could mislead stakeholders about the firm's risk posture. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the observed problem with the control technique's effectiveness. Second, conduct a root cause analysis, examining both the initial risk assessment and the implementation process. Third, consult relevant internal policies and external regulatory guidance, e.g., FCA Handbook, relevant industry best practices. Fourth, develop and implement corrective actions based on the findings, which may involve refining the control, reassessing the risk, or selecting an alternative technique. Finally, monitor the effectiveness of the implemented changes. Question 15. The efficiency study reveals that the historical loss data for a specific business line appears to be significantly inflated by a few exceptionally large, infrequent claims. The risk financing team is considering adjusting this data to present a more normalized view for future risk transfer negotiations and capital allocation. What is the most appropriate course of action? Adhering strictly to the regulatory framework and ethical guidelines for the advanced risk financing and transfer exam. Option A. Exclude all claims exceeding a certain monetary threshold from the historical data to present a more manageable loss profile for negotiations. Option B. Conduct a thorough review of the large claims to determine if they were truly exceptional and document the methodology used for any adjustments or exclusions, ensuring transparency and consistency with actuarial standards. Option C. Adjust the historical loss data to align with the projected loss budget for the upcoming financial period, thereby demonstrating improved cost control. Option D. Make subjective adjustments to the loss data based on the team's collective experience and intuition about future loss trends, without formal documentation. The correct answer is B. Conduct a thorough review of the large claims to determine if they were truly exceptional and document the methodology used for any adjustments or exclusions, ensuring transparency and consistency with actuarial standards. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the ethical obligation to accurately represent historical loss data. The temptation to manipulate data for short-term financial gain or to meet performance targets can compromise the integrity of risk financing and transfer strategies. Careful judgment is required to ensure that any adjustments to loss data are transparent, justifiable, and aligned with regulatory expectations for data integrity. The correct approach involves a thorough and documented review of the loss data, identifying any anomalies or outliers, and applying consistent, predefined methodologies for adjustment or exclusion. This approach is ethically sound and regulatorily compliant because it upholds the principle of data accuracy, which is fundamental to sound actuarial practice and risk management. Specifically, regulatory frameworks governing financial reporting and insurance operations, e.g., those overseen by the Financial Conduct Authority in the UK, or similar bodies in other specified jurisdictions, mandate that financial information, including loss data used for reserving and pricing, must be presented fairly and without material misstatement. Transparency in data handling and the use of objective criteria for adjustments are key to demonstrating compliance and maintaining stakeholder trust. An approach that involves selectively excluding large, infrequent losses without a clear, documented, and justifiable rationale is ethically problematic and likely to violate regulatory principles. Such selective exclusion can distort the true loss experience, leading to underestimation of future losses and potentially inadequate pricing or reserving. This misrepresentation can be viewed as misleading and a breach of professional duty. Another incorrect approach would be to adjust historical loss data to align with a predetermined target or budget. This is a clear ethical failure, as it prioritizes financial targets over factual representation. Regulators expect loss data to reflect actual events, not to be manipulated to fit desired outcomes. This practice undermines the reliability of risk financing models and can lead to significant financial instability if actual losses exceed the artificially lowered expectations. Finally, an approach that involves making subjective adjustments to loss data based on anecdotal evidence or personal judgment, without robust supporting documentation or a consistent methodology, is also professionally unacceptable. This lack of objectivity and transparency can lead to inconsistent and unreliable data, which is a direct contravention of professional standards and regulatory requirements for data integrity and auditability. The professional decision-making process in such situations should involve a commitment to data integrity as the paramount principle. This means adhering to established actuarial standards of practice, seeking peer review for significant data adjustments, and maintaining comprehensive documentation of all data handling processes. When in doubt, professionals should err on the side of caution and transparency, ensuring that any data used for risk financing and transfer decisions is a true and fair reflection of historical experience, subject to clearly defined and justifiable adjustments. Question 16. Comparative studies suggest that the regulatory treatment of insurance-linked securities (ILS) can vary significantly based on the jurisdiction's approach to financial services regulation and investor protection. Considering the UK regulatory framework and SISI guidelines, which of the following approaches to the structuring and marketing of an ILS fund would be most compliant with current regulations? Option A. Marketing the ILS fund to a broad audience of retail investors, emphasizing its diversification benefits and low correlation to traditional asset classes, without specific disclosure of the trigger events or the potential for full capital loss due to extreme weather events. Option B. Offering the ILS fund directly to retail investors through a simplified information memorandum that highlights the potential for attractive returns, with a disclaimer that the investment carries significant risk, without detailed disclosure of specific catastrophe modeling or collateral arrangements. Option C. Establishing the ILS fund as an unregulated collective investment scheme, relying on the assumption that sophisticated investors will conduct their own due diligence, and providing minimal disclosure on the underlying risks to reduce marketing complexity. Option D. Structuring the ILS fund as a UCITS scheme with a clear and comprehensive prospectus detailing all underlying risks, including catastrophe event probabilities and potential loss scenarios, and marketing it only to professional investors and eligible counterparties who have been assessed for suitability. The correct answer is D. Structuring the ILS fund as a UCITS scheme with a clear and comprehensive prospectus detailing all underlying risks, including catastrophe event probabilities and potential loss scenarios, and marketing it only to professional investors and eligible counterparties who have been assessed for suitability. Explanation. This scenario is professionally challenging because it requires a deep understanding of the regulatory landscape governing insurance-linked securities (ILS) within the specified jurisdiction, which is assumed to be the United Kingdom for this exam, aligning with SISI guidelines. The challenge lies in navigating the complex interplay between financial regulation, insurance law, and investor protection when structuring and marketing ILS products. Professionals must exercise careful judgment to ensure compliance with all applicable rules, particularly concerning disclosure, suitability, and the management of risks associated with these sophisticated financial instruments. The correct approach involves a thorough assessment of the ILS product structure, underlying risks, and target investors against the requirements of the Financial Conduct Authority (FCA) handbook, specifically focusing on regulations pertaining to collective investment schemes, prudential requirements for insurers, and rules on marketing financial products to retail and professional clients. This includes ensuring that all material risks are clearly and accurately disclosed in the offering documents, that the product is suitable for the intended investor base, and that the issuer adheres to ongoing reporting and capital adequacy requirements. Regulatory justification stems from the FCA's overarching objective to protect consumers, maintain market integrity, and promote competition. Adhering to these principles ensures that investors are adequately informed and protected, and that the ILS market operates in a stable and transparent manner, thereby fulfilling the regulator's mandate. An incorrect approach that focuses solely on the potential for higher yields, without adequately addressing the inherent volatility and complexity of ILS, would fail to meet regulatory standards. This would constitute a breach of the FCA's principles for businesses, particularly Principle 7, Communications with Clients, and Principle 9, Skill, Care, and Diligence, by misrepresenting the risk profile of the investment. Another incorrect approach might involve marketing the ILS product to retail investors without conducting a robust suitability assessment, or ensuring that the product meets the criteria for being offered to such investors under the FCA's Conduct of Business Sourcebook, COBS. This would violate rules designed to prevent retail clients from investing in products they do not understand or that are not appropriate for their financial situation, leading to potential regulatory sanctions and reputational damage. A third incorrect approach could be to overlook the prudential requirements for the said insurer, such as solvency and capital adequacy, which are critical for the stability of the ILS market and the protection of policyholders. Failure to comply with these prudential rules, as outlined in the Prudential Regulation Authority (PRA) rulebook, could undermine the financial soundness of the insurance entity and, by extension, the ILS market. Professionals should adopt a decision-making framework that prioritizes a comprehensive understanding of the regulatory environment, a rigorous risk assessment of the ILS product, and a clear articulation of the product's characteristics and risks to potential investors. This involves proactive engagement with regulatory guidance, seeking legal and compliance advice, and maintaining a robust internal control framework to ensure ongoing adherence to all applicable rules and principles. Question 17. The audit findings indicate a potential breach of environmental regulations concerning historical waste disposal at a company-owned facility. The internal engineering team has proposed a remediation plan that they believe is cost-effective and addresses the immediate environmental concerns, but they have not consulted with external environmental legal counsel or specialized environmental consultants. What is the most appropriate course of action to ensure compliance and mitigate risk? Option A. Delay the remediation process and monitor the situation to assess if regulatory action is taken before committing to significant expenditure. Option B. Immediately engage specialist environmental legal counsel and a qualified environmental consultant to assess the situation and develop a compliant remediation plan. Option C. Proceed with the remediation plan proposed by the internal engineering team, as it is deemed cost-effective and addresses the immediate concerns. Option D. Seek general legal advice from the company's existing corporate counsel to understand the potential legal implications before proceeding with any remediation. The correct answer is B. Immediately engage specialist environmental legal counsel and a qualified environmental consultant to assess the situation and develop a compliant remediation plan. Explanation. This scenario is professionally challenging because it requires balancing the immediate financial implications of a remediation project with the long-term legal and reputational risks associated with environmental noncompliance. The audit findings highlight a potential breach of environmental regulations, necessitating a decision on how to proceed with remediation. Careful judgment is required to ensure that the chosen approach aligns with the firm's legal obligations, ethical responsibilities, and risk management strategy. The correct approach involves immediately engaging specialist environmental legal counsel and a qualified environmental consultant to assess the full scope of the issue and develop a compliant remediation plan. This is the best professional practice because it prioritizes adherence to the relevant environmental laws and regulations, which are paramount in this context. Engaging experts ensures that the remediation is conducted effectively, minimizes further environmental damage, and satisfies regulatory requirements, thereby mitigating the risk of fines, legal action, and reputational damage. This proactive and expert-driven strategy demonstrates a commitment to responsible corporate citizenship and robust risk management. An incorrect approach would be to proceed with remediation based solely on internal engineering assessments without external legal or environmental expert input. This is professionally unacceptable because it risks overlooking critical regulatory nuances, failing to meet specific legal standards for remediation, and potentially exacerbating the environmental problem. Demonstrates a lack of due diligence and a disregard for the specialized knowledge required to navigate complex environmental law. Another incorrect approach would be to delay remediation or attempt to minimize its scope to reduce immediate costs, hoping the issue goes unnoticed. This is ethically and legally unsound. It constitutes a failure to comply with environmental obligations, exposes the firm to significant future penalties, and can lead to severe reputational damage if discovered. It prioritizes short-term financial gain over long-term legal and ethical responsibilities. A further incorrect approach would be to rely on general legal advice not specific to environmental law. While legal counsel is essential, Environmental law is a highly specialized field. General advice may not adequately address the specific statutory requirements, permitting processes, or reporting obligations mandated by environmental legislation, leading to an incomplete or non-compliant remediation effort. The professional decision-making process for similar situations should involve a structured risk assessment that includes 1. Identifying the potential legal and regulatory obligations. 2. Assessing the environmental impact and potential liabilities. 3. Consulting with appropriate internal and external experts, legal, environmental, technical. 4. Evaluating the costs and benefits of different remediation strategies, considering both immediate and long-term implications. And 5. Selecting and implementing the approach that best ensures compliance, minimizes risk, and aligns with ethical principles. Question 18. Investigation of a financial institution's capital budgeting process reveals a proposal for a new product line with a projected high internal rate of return. However, preliminary analysis indicates that launching this product would significantly increase the firm's risk-weighted assets, potentially pushing its common equity Tier 1 ratio below the minimum regulatory threshold. Which of the following approaches best aligns with the regulatory framework for advanced risk financing and transfer, ensuring both strategic growth and prudential capital management? Option A. Conduct a comprehensive capital budgeting analysis that quantifies the project's impact on regulatory capital ratios and solvency, and only proceed if the project, when considering its capital implications, remains within acceptable regulatory limits and enhances overall capital adequacy. Option B. Seek regulatory approval for a temporary waiver of the common equity Tier 1 ratio requirement, arguing that the projected returns will eventually allow the firm to replenish its capital. Option C. Proceed with the investment if the projected internal rate of return exceeds the firm's cost of capital, as this indicates a profitable opportunity that will ultimately strengthen the firm. Option D. Reject the investment outright due to the potential breach of the common equity Tier 1 ratio, prioritizing immediate regulatory compliance over potential future returns. Correct answer is C. Proceed with the investment if the projected internal rate of return exceeds the firm's cost of capital, as this indicates a profitable opportunity that will ultimately strengthen the firm. Explanation: this scenario is professionally challenging because it requires a financial manager to balance the pursuit of strategic growth with strict adherence to regulatory capital requirements and prudent risk management principles. The decision to invest in a new, potentially high-return project necessitates a thorough evaluation of its impact on the firm's capital adequacy and solvency, as mandated by regulatory bodies. The manager must not only consider the project's profitability, but also its potential to strain capital resources or introduce unmanageable risks that could jeopardize the firm's financial stability and regulatory compliance. The correct approach involves a comprehensive capital budgeting analysis that explicitly incorporates regulatory capital requirements. This means evaluating the project not just on its expected net present value, NPV, or internal rate of return, but also on its impact on key regulatory capital ratios, e.g., common equity Tier 1 ratio for banks or solvency ratios for insurers. The analysis must consider the risk-weighted assets, RWA, associated with the project, and how these will affect the firm's overall capital adequacy. This aligns with the regulatory framework's objective of ensuring that financial institutions maintain sufficient capital to absorb unexpected losses and protect depositors, policyholders, and the broader financial system. Specifically, regulations like those derived from Basel Accords for banks or Solvency Roman II for insurers mandate that capital levels be commensurate with the risks undertaken. Therefore, a project that significantly erodes capital adequacy or increases RWAs without a proportional increase in capital would be deemed unacceptable, regardless of its standalone profitability. An incorrect approach would be to solely focus on the project's standalone financial metrics, such as its NPV or IRR, without considering its impact on the firm's regulatory capital position. This fails to acknowledge the fundamental regulatory principle that capital is a buffer against risk, and its adequacy is paramount for the firm's survival and the stability of the financial system. Such an approach could lead to investments that, while appearing profitable in isolation, ultimately weaken the firm's financial resilience and expose it to regulatory sanctions or even insolvency. Another incorrect approach would be to prioritize short-term profitability or market share gains over long-term capital strength and regulatory compliance. This might involve undertaking projects that generate immediate revenue but carry significant latent risks or require substantial capital deployment that depletes reserves. This disregards the forward-looking nature of capital regulation, which aims to prevent crises by ensuring firms are adequately capitalized for future uncertainties. A third incorrect approach would be to adopt a wait-and-see attitude, delaying necessary capital investments or risk mitigation measures in the hope that regulatory requirements might change or that market conditions will improve. This passive stance is contrary to the proactive risk management and capital planning expected by regulators. It fails to address the current risk profile and capital needs of the firm, potentially leading to a breach of regulatory thresholds. The professional decision-making process for similar situations should involve a structured framework that integrates financial analysis with regulatory compliance. This includes 1. Identifying all relevant regulatory capital requirements and solvency standards applicable to the firm's jurisdiction. 2. Conducting a thorough risk assessment of the proposed project, quantifying its potential impact on RWAs and other risk metrics. 3. Performing a capital budgeting analysis that explicitly models the project's effect on key capital ratios and overall capital adequacy. 4. Stress testing the project and the firm's capital position under various adverse scenarios to assess resilience. 5. Ensuring that any investment decision demonstrably supports or maintains the firm's compliance with regulatory capital mandates, thereby safeguarding its financial health and market reputation. Question 19. Benchmark analysis indicates that a client, a large agricultural cooperative, is seeking to mitigate the financial impact of unseasonably low rainfall during the upcoming growing season. An investment firm proposes a weather derivative contract that pays out based on the cumulative rainfall in a specific region falling below a predetermined threshold. Considering the regulatory framework for financial services in the UK, which of the following represents the most appropriate approach for the investment firm when advising the cooperative on this weather derivative? Option A. Treat the derivative as a bespoke insurance contract, focusing solely on the cooperative's hedging objective and providing a simplified explanation of the payout mechanism. Option B. Focus on the potential upside of the derivative for the cooperative if rainfall is significantly below the threshold, while downplaying the potential for losses if rainfall is above it. Option C. Advise the cooperative that as a sophisticated counterparty, they can enter into the derivative as an unregulated over-the-counter transaction, with minimal disclosure beyond the basic terms of the contract. Option D. Classify the derivative according to its underlying economic function and regulatory definition within the UK, ensuring all applicable disclosure requirements, including a key information document, KID, if mandated, and suitability assessments are rigorously performed. Correct answer is A. Treat the derivative as a bespoke insurance contract, focusing solely on the cooperative's hedging objective and providing a simplified explanation of the payout mechanism. Explanation. This scenario is professionally challenging because it requires a deep understanding of how weather derivatives are regulated within the specified jurisdiction, particularly concerning their classification and the implications for client suitability and disclosure. The challenge lies in correctly identifying the regulatory treatment of a specific weather derivative product and ensuring that the advice provided aligns with the principles of client protection and market integrity as mandated by the relevant regulatory framework. Careful judgment is required to navigate the nuances of financial product regulation and to avoid misrepresenting the nature or risks of the derivative. The correct approach involves accurately classifying the weather derivative based on its underlying mechanics and the regulatory definitions within the specified jurisdiction. This classification dictates the appropriate regulatory regime, including disclosure requirements, suitability obligations, and potential restrictions on who can offer or purchase such products. Adhering to this approach ensures compliance with the spirit and letter of the law, protecting clients from unsuitable investments and maintaining market confidence. Specifically, if the weather derivative is deemed a regulated investment or derivative product under the relevant legislation, then all associated regulatory obligations, such as providing a key information document, KID, or equivalent, conducting suitability assessments, and ensuring appropriate risk warnings are given, must be meticulously followed. This aligns with the overarching regulatory objective of ensuring fair treatment of customers and the orderly functioning of financial markets. An incorrect approach that misclassifies the weather derivative as a simple insurance product would fail to acknowledge its potential for speculative trading and its complex risk profile, which may differ significantly from traditional insurance. This failure would lead to a breach of regulatory requirements concerning the sale of investment products, potentially exposing clients to risks they do not understand or are not equipped to bear. It would also bypass essential disclosure obligations, such as providing detailed risk warnings and product information, thereby violating principles of transparency and client protection. Another incorrect approach that treats the weather derivative as an unregulated over-the-counter (OTC) instrument without considering any specific regulatory pronouncements or guidance on such products would be equally problematic. Even if not explicitly listed as a regulated instrument, regulators often have broad powers to bring complex financial products within their purview if they pose systemic risks or are used in ways that could harm consumers or markets. Failing to investigate and adhere to any applicable regulatory guidance or interpretation regarding weather derivatives would be a significant oversight, potentially leading to noncompliance with market conduct rules and disclosure obligations. A third incorrect approach that focuses solely on the potential hedging benefits for the client without a thorough assessment of the derivative structure, risks, and the client's overall financial situation and risk tolerance would also be professionally unsound. While hedging is a legitimate use case, it does not absolve the advisor of their regulatory duties. A comprehensive assessment, including understanding the derivative's payoff structure, its sensitivity to weather events, and its potential for losses, is paramount. This approach would neglect the regulatory requirement for suitability, which mandates that financial products recommended to clients must be appropriate for their individual circumstances, knowledge, and experience. A professional reasoning process for similar situations should begin with a thorough understanding of the client's objectives and risk appetite. This should be followed by an in-depth analysis of the proposed financial product, including its structure, risks, and potential benefits. Crucially, this analysis must be grounded in the specific regulatory framework of the jurisdiction. Professionals must actively research and consult relevant legislation, regulatory guidance, and supervisory pronouncements to determine the product's classification and the associated compliance obligations. If there is any ambiguity, seeking clarification from the regulator or legal counsel is advisable. The final recommendation must be supported by a clear rationale that demonstrates compliance with all applicable regulatory requirements, particularly those related to disclosure, suitability, and fair treatment of customers. Question 20. The evaluation methodology shows a firm attempting to assess the potential impact of a cyber attack on its operations. Which of the following approaches best aligns with a comprehensive and regulatory compliant impact assessment? Option A. Relying on historical data from unrelated past incidents to estimate potential losses. Option B. Prioritizing only the most easily quantifiable impacts, such as immediate IT recovery expenses. Option C. Focusing solely on direct financial losses such as IT system recovery costs. Option D. Conducting a broad assessment that considers financial, operational, legal, and reputational impacts across all business units. The correct answer is C. Focusing solely on direct financial losses such as IT system recovery costs. Explanation. The evaluation methodology shows a firm attempting to assess the potential impact of a cyber attack on its operations. This scenario is professionally challenging because the interconnectedness of modern business systems means a single event can have cascading effects across multiple business functions, financial performance, and reputational standing. Accurately quantifying these impacts, especially intangible ones like reputational damage, requires a nuanced understanding of risk and a robust assessment framework. Professionals must exercise careful judgment to avoid underestimating or overestimating potential losses, which can lead to misallocation of resources for risk mitigation. The correct approach involves a comprehensive impact assessment that considers both direct and indirect consequences across all relevant business areas. This includes financial losses, e.g., lost revenue recovery costs, operational disruptions, e.g., downtime, supply chain interruptions, legal and regulatory penalties, e.g., fines for data breaches, and reputational damage, e.g., loss of customer trust, negative media coverage. This holistic view aligns with the principles of prudent risk management expected under regulatory frameworks that mandate a thorough understanding of potential threats and their consequences. Ethically, it demonstrates a commitment to protecting stakeholders by proactively identifying and preparing for adverse events. An approach that focuses solely on immediate financial losses, while important, is incorrect because it fails to capture the full spectrum of potential harm. Regulatory guidelines often require consideration of non-financial impacts, such as reputational damage, which can have long-term financial repercussions. Ignoring these aspects leads to an incomplete risk profile and inadequate mitigation strategies, potentially violating a duty of care to shareholders and customers. An approach that relies on anecdotal evidence or past, unrelated incidents is also incorrect. This method lacks the systematic rigor required for effective risk assessment. Regulatory expectations demand data-driven and structured analysis, not subjective interpretations. Basing decisions on insufficient or irrelevant data can lead to significant misjudgments about the likelihood and severity of impacts, failing to meet professional standards of due diligence. Finally, an approach that prioritizes only the most easily quantifiable impacts, such as direct IT recovery costs, is insufficient. While these are critical, they often represent only a fraction of the total potential impact. Regulatory bodies expect a forward-looking assessment that considers the broader business implications, including business interruption and potential loss of market share. Failing to do so represents a failure to adequately assess and manage enterprise-wide risks. Professionals should employ a structured, multifaceted impact assessment process. This involves defining clear assessment criteria, gathering relevant data, both quantitative and qualitative, engaging with subject matter experts across different departments, and considering a range of scenarios. The process should be iterative, allowing for refinement as new information becomes available. This systematic approach ensures that all significant potential impacts are identified, understood, and factored into risk financing and transfer decisions, thereby meeting regulatory expectations and ethical obligations.